Thank you very much. Yeah, always a pleasure to be asked by graduate students organising a seminar, and also specialised in DeFi. I mean, maybe it's the only one that is specialised in DeFi, I'm not sure, but really good to speak to an educated audience. So, yep, this is what I'm talking about. This is a paper that started off as a blog when I saw what was happening to the eigenlayer, and I thought, oh, I blog about it, but it just grew. And it became a paper last summer, and then I had to drop it for various, other work priorities. And it's good that this seminar has now got me back into looking at the paper again, and I'll have to make a revision because, of course, 6 months, everything changes. So here we are. What am I going to be talking about? Well, let's start off with looking at DeFi, total value locked, a measure of the growth of various protocols and other developments on chain. And you can see, of course, the TVL as measured by DeFi Llama. Let's just click on that to get a bit of a better view. Here we are. So, from did very little until about oops, what am I doing now? As always, live demos do funny things, right? From about the 2021, when the crypto markets really started taking off. And then, of course, we had the Terra Luna crisis here and the DeFi winter. But things are now coming back. And this growth here corresponded to the growth in eigenlayer. If we look at the Aave, Lido, of course, lending, liquid staking, these have been number 1 and 2 protocols for quite a long time, but now the eigenlayer is number 3. And this thing called EtherFi, which is a newer entrant, I will be focusing on more here than I did in the paper, actually. Big question mark there. I mean, there's a lot of double counting that goes on, and I'll talk about that in the seminar. All right, so we can see that the growth in TVL is really along the axis of lending, liquid staking, and now restaking. That's where most of the DeFi developments are. And the eigenlayer, looking at the total value lock, went up to 20 billion, and it's, hovering around 15 billion at the moment. They actually launched their Eigen governance token a few months ago, and you can see its price has been hovering between $2 and $5 or $6. The USD value of the inflows of S and liquid staking tokens, which can be used for the restaking process, there's a lot there, and there's outflows as well. Okay, so that's quick picture. What is this eigenlayer then? It's a set of smart contracts that allow holders of Ether and any LSTs, these liquid staking tokens you get from Lido and other liquid staking providers. The Lido one is called STES, but there are all sorts of other ones as well. These are rehypothecated, a new category of tokens. All the wrapped tokens and all the liquidity pool tokens and all the tokens that are sort of wrapped and or given one for one. Yeah, so, and the eigenlayer supports things called actively validated services. And what are they? They are services in the ecosystem, but unlike roll-ups, which are validated by the Ethereum beacon chain, they require a separate independent distributed validation. And they can potentially include lots of things, Oracle networks, sequencers with a maximum extractable value in Ethereum, bridges between blockchains, side chains, a few other L2s, not roll-ups though, virtual machines other than the EVM, data availability, execution environments. One of the things I've just got really interested in are the intents-based markets. Very, very interesting. And anyway, so potentially, but at the moment, there's only 31 actively validated services. June, this hash chap does lots of statistics for us. We can see here on the right, 31 rows. The biggest one with 553 is the eigen data availability. And that is designed for roll-ups, for the data for roll-ups. But there are all sorts of other ones. Some of them, though, are, not very many operators at all. GASP finalizer, I've no idea what that is, but, they're still at a fairly nascent stage of development, and there's only 31 of them. So, it's work in progress, shall we say. Now, because you're validating,
can we interrupt? Can we make it a little interactive since we're a small group?
As long as I can finish. I've never given this talk before. It's totally new, so I don't know whether I'm going to finish. So let's see. But anyway, yeah, please.
Okay. Well, just it's more of a comment than a question, I guess. But if you go back to the previous slide, data availability is sort of the killer app for EigenLayer, I would think of, because fundamentally, unless you get 100% buy-in by all the validators, anything that needs to get in the next block is problematic for restaking protocols. But anything that doesn't need to get into the immediately next block and is not timely, but just needs security and deployment, that would be a good application of restaking.
Yeah. Okay.
And data availability, I need a bunch of nodes.
For that comment. Yeah, maybe we should have perhaps not during this seminar, but maybe at another time you and I can have a chat about
Sure.
what you said
Sure.
there. It's just that I've got a lot to get through.
Go ahead.
Thank you. All right, so because there are slashing penalties for ordinary validators on the Ethereum main chain. If they're late for the slot or they try to double count transactions or something like that, there are slashing penalties. But they're greater for validators of the EigenLayer because you also got the credit risk and things like that. And EigenLayer make it very clear that it is the validator's responsibility to do the due diligence check on the AVS that they select. So, so there are increased risks, but should be reflected by higher rewards. So what do I do in this paper? Well, it's an economic analysis. So much of the literature now in decentralized finance is dominated by computer scientists. And finance professors are a bit slow to I mean, there are a few. Will Kong is one of them. But my background is risk management. I moved into risk management in the 90s from mathematics. So I always look at the risks. So market credit operational risks for the intermediaries, in particular Lido and Aave, the two big protocols. What sort of risks are they running? Or what sort of risks are their users running, more to the point? And then there are a few formulae that I derive for what the leveraged return can be from what we call looping many rounds of liquid staking and liquid restaking, and then a mixed strategy, which is why I started getting very interested in Ether.fi, because that seems to be what Ether.fi are now doing, that mixed strategy. Okay, so it's all about risks. I didn't put it in the paper, in the title here, because I couldn't get it on the bottom, but there we are. It focuses on risk. The related literature is pretty sparse. Actually, this paper has been published just, I think, well, it's coming out next month as preprint on this one. This one's accepted by the Journal of Futures Markets, but most of the others are still just discussion papers. So as I said, Will Kong's done an economic model of staking versus transaction, but no leverage or looping or anything like that. These guys look at historical depegs. A lot of the focus in the literature is just on depegs, using the Terra Luna crisis as an example of the systemic risks that can arise when you have a depeg of a liquid staking token. And then the same team, this is from William Nottenblatt, Imperial's group. They look at arbitrage potential between the minting of the LSTs and the secondary markets. And then Liu et al., they look at the double counting of total value locked, looking at a different concept, total value redeemable. And that I touch on that as well. All right, so the first part of the talk is leveraged liquid staking. And just to go through, not everybody in the audience, I guess, is going to know what liquid staking is. So very quickly, I'll just summarize. After the merge, validator nodes, they propose and attest blocks in a proof of stake chain like Ethereum and other proof of stake chains, similar construct. So, you know, there's 128 of them, and one of them is the proposer and the others a test. And since the merge, we've had PBS, the proposer builder separation, and now the building is farmed out, and there's all these auctions, which is where the intense markets come in. But I'm not talking about that. Just the basic 32S will give you the stake for a validator node. You have to have 32S, which you deposit, and you receive the rewards in the native token as well. And then, of course, if you've only got 4S, you can join Lido and pool your S with others, and Lido run their own Ethereum validator nodes. If I use Lido, then I get a liquid staked token like Steth, which is the Lido token, which I can use elsewhere in DeFi, just like the LP tokens that you get for providing liquidity in Uniswap. And this is where the double counting starts to come in, because I can swap LSTs using my MetaMask wallet if it's an Ethereum one. I could trade it, or I could use liquidity provision on DEXs. I could use it for collateral on Aave, and anywhere in DeFi really. But if I swap the LST, then I lose the staking rewards. The staking rewards accrue to the current LST holder, and then I can unlock my original F stake by returning the LST to Lido. And that's pretty quick and seamless compared with the restaking protocols, where trying to redeem easy S is not at all easy. I mean, it didn't used to be that you could unlock your liquid staking token. I mean, you couldn't unlock STES until after the merge, and that did create a lot of liquidity problems that I'm going to be talking about here, because they're now pertinent to the Aave v3 pools, where you can Aave v3 protocols, where you can borrow, you can use EZS as collateral. Anyway, I'm jumping ahead of myself. That's just a summary of liquid staking. And when you go on to Lido now, and they used to validate 3 or 4 chains, Kumara was one, Polygon, and a few others, but now they're really just focusing on Ethereum. And the APR, you can see, this currently is 2.9%. And on the right, you can see the yield on Treasury bills, 3 months, 6 months, 12 months. Treasury bill yields are like more than 4%. So obviously, liquid stakers need to profit from using that LST elsewhere. They could provide liquidity, but then impermanent loss is an issue. It erodes your income from liquidity provision. They could just supply it on Aave, but the supply APY is very, very low on wrapped Steth here. So that's why looping became a thing. And this is a schematic of looping. Starting off number one, you stake, say, 100 S on Lido, and you get 100 STES back. It's always 1 for 1. And then you can use that STES on collateral, on Aave v2. You set a loan to value ratio, maybe 75%. And depending on the price of STES, because it's not always exactly 1, it might just be, I don't know, 0.99. It's pretty well pegged, those STES. You would get, say, 75%, well, 0.99 times 75, if that was your loan to value that you targeted. But actually, I mean, they change over time. Loan to values now, the maximum on Aave v2 for STES is like 72%, right? And then, so you borrow that amount of S. So 75% loan to value, price 1, you would borrow 75 S, or maybe a little less S if STES is below the peg. And then you just go round and round as many times as you like. I tried doing this, and I realized that it may be fine for big institutions because gas fees are just gas fees. It's not proportional to the amount you're transacting. But if you're just transacting a little amount, then gas fees are going to be significant. It's got to be a large amount of S that you're doing this.
Can I ask a clarifying question here? Suppose I think for this looping to work, don't you need the borrowing rate from Aave? It's going to be less than the interest rate you're getting from Lido. In which case, why won't the Aave, why won't the query on Aave just go to Lido?
I don't quite understand what you say. Can you start again? You say the borrow rate. Borrow
Right.
rate is usually higher than the supply rate. You pay more interest than you get, yeah?
Right. And what's my
Oh,
incentive to do this staking on um to get my stats as collateral on Aave? If I have to pay more than
because
what I
then
would get.
because I can borrow more S and then I can put more S on Lido. And instead of staking 100 S on Lido, I can stake 175 S. So I get more rewards.
Right, but wouldn't those rewards, so I suppose those rewards is more than the interest I have to pay on Aave? Why wouldn't
Yeah.
the Aave liquidity provider just directly go to Lido but stay at Aave? Does that make sense? Like, so because when I use my stats as collateral on Aave, I borrow more ETH, which allowed me to stake it on Lido again.
Yeah,
But if that's
because I can't
profitable,
stake STES on Lido. I can only
right? But
stake.
but if that's profitable enough, um, shouldn't the Aave, whoever that deposit ETH into Aave, directly deposit to Lido to stake on Lido so they can earn more rewards?
Maybe, but I mean, it is possible to do that. I'm not saying that everybody in this space is rational. I'm
I see.
certainly not. I mean,
Okay.
I keep my stuff in MetaMask and make the most awful investments. But yeah, it may be more rational for people not to provide S collateral on Aave, rather to use Lido instead. Yes, I get that. It may well be rational to do that. Another question? Yeah.
So, what is the reserve that Lido keeps against all of the loans that it hands out? What happens if there's a run on Lido?
Yeah. I'd have to look that up. I don't know offhand, but that's a good question. I might dig into that further. Yeah.
Okay, so at a high level, to sort of pile on Kite's question, at a high level, I look at both Lido and Aave as banks. people put deposits to get immediate yields, and other people borrow, money from the bank and pay back interest.
Why both Aave and Lido? Aave, yeah, is like a shadow bank.
Also Lido, right?
Is a liquid staking. Or Lido is a liquid staking protocol.
Okay, yeah, I think they refer to themselves as Lido. I could be wrong. What's the difference between liquid staking and a bank?
Well, a bank doesn't secure the Ethereum blockchain.
That just means how does the bank invest the deposits that user put? In Lido's case, the main investment is getting rewards by becoming Ethereum validators and staking the money that the bank. But that's just an investment. And I'm saying let's look at it as a 30,000
assets that have all sorts of credit risk, operational risks, and so forth. I mean, derivatives trading by investment banks is massive. Ordinary banks are betting more than the world GDP on derivatives markets if you include interest rate swaps. They've got a nominal of more than 400 billion, something like that. Interest rate swaps. Anyway, but that's not really the question, I think, that is central to this seminar. Shall I go on?
I want to just ask.
We're almost halfway through the time, and I'm on slide 10. So maybe we shouldn't have quite so many questions.
Okay. Very good.
Okay. All right. So you can follow through the math in the paper. It's very easy to show that the leverage you get from N loops depends on the target loan to value, which I've already mentioned, and the price of stETH. And this leverage term is always at least 1 and tends to, when N tends to infinity, it'll be 1 over 1 minus PS, lambda S. And so, I mean, maximum value about 4, given the loan to value is around 75% maximum. And then a few more lines of maths in the paper will show that the leverage return is given by this expression, where alpha S is the APR you get from Lido, and phi S is the net interest rate on the supplied S and borrowed S. Supplied stETH and borrowed S. Okay. Hang on, let's go down. And then there's an Excel spreadsheet you can get on my website. My website's on the first slide in this seminar, www.coalexander.com, and I've got a resources section where I put up all my old lecture notes and about 5,000 Excel workbooks from my market risk analysis book series. And they've got all sorts of things for ordinary finance people, like pricing exotic options and so forth. And I put this up there, so you just need to register with your email and you can download this spreadsheet. But what it shows, and you can change these things here, not counting gas fees, is that instead of 2.9%, with 5 rounds of looping, you could get between 6 and 8% return. With 20 rounds of looping, you can get between 6 and 11% return. And most of the leverage return, 10 rounds is adequate. You get quite a lot already with 5. Keep going back in my slides. Hang on. And then with the double counting, again, a little bit of algebra, you've got your initial stake of NS. That is the new fiat that you brought in to the system. Everything else is hypothecated. You got your stETH, and you've done N rounds of looping, and the total value of your stake, which is counted on both Lido and in Ethereum, also counted on Aave, is the total collateral that you've deposited. only n-1 rounds here because you didn't have to borrow for the first. I'm saying that you brought in a new fiat of ns. So this term here, I mean, looking at it, it's got to be, well, should be at least 3 because these leverage terms are at least 1. When I look at the DeFi llama, let me just have a look at it. It automatically gives you the TVL for borrowing on Aave. Let's take that off. Double counting, liquid staking, take all those things off. Just do staking on Ethereum and your TVL is 133. Before I did that, that's currently the maximum of about just over 200. Before I did that, it was about 260 billion. And that's only about double. So there's something a little bit wrong with the way DeFi llama are counting TVL, I think. Certainly deserves closer look. And then this is something that was also covered by William Nottenblatt's group in Imperial, DPEG-driven Aave liquidation cascades. So if the price of STES falls, so does the value of the collateral, obviously, and that will change your loan to value ratio. It will go up if the price of S falls. And Aave users have a very simple thing that they have to monitor on their app that they use for Aave called their health factor. And if it exceeds 1, then the loan becomes eligible for liquidation. And this is farmed out. Aave want to get rid of bad loans, so they farm it out to professional liquidators. And they run bots. You can get the code very easily from GitHub. I give you the link in the paper. If you want to run your own bot, monitor the health factor. And if you do that, you get a bonus that's paid by the depositor out of their remaining collateral. On their Aave version 2, the maximum that can be liquidated is 50% of your collateral. But on Aave version 3, there are 2 upper thresholds to loan to value. And if it exceeds the upper one, 100% could be liquidated. So, okay, you're liquidated. If the liquidators just hold on to the STES, they just get the staking reward. But if they want to swap STES for F, then you could have some pretty large swaps of STES into DEXs, which of course, because of the automated market making mechanism, is going to precipitate a price fall in STES. And that's what was documented in this paper by Zhang et al. So at the time I did this, this was last May. I haven't looked at the paper much since until a couple of days ago. The liquidation threshold now is 83%. Maximum loan to value is 72%. So suppose you put in around that. 83% means, you know, if the STES price went down to 0.9 or 0.88 or something like that, then your loan would be liquidated. And the STES price, even on Balancer, which is one of the most liquid DEXs, went down to 0.81 at the Terra Luna crisis. So, and EZS, which is what I'm going to talk about next, is far more unstable. That's the Renzo protocol one. So, shall we take a question? Any more questions before I get on to the next part of the seminar? Got half an hour left. Okay.
Yeah,
so
again, I would just reiterate, perhaps, again, this is more of a comment than a question. You know, if you compare this to the traditional financial world, which is also leveraged, but there are some regulations on, you know, the amount of reserve you have to maintain. There's Basel standards and this standard.
Yes.
Is there anything like this here, or this is completely Wild West?
There's some auditing, and you know, it's governed by DAOs, but there's no central regulation, and more importantly, there's absolutely no cap on the leverage that you can use on centralized exchanges like Binance and Bybit, you can use 100 times leverage on those exchanges, like a 1% margin. On the CME, which is the only regulated derivatives exchange for Bitcoin and Ether futures and options, they use risk-based margins, and that comes up to about a 50% margin, much bigger than S&P 500 futures and options, futures. I mean, so margins are really tiny, and these liquidation cascades are even more common in centralized exchanges than they are on these protocols. Yeah, I mean, this is before I retire, which I should have done 5 years ago, but before I retire, it's my mission to bring regulation into DeFi. So,
by the way, maybe I should introduce and say I am a computer scientist on this call. I am not an economist.
Okay. You're the one that I write about in the paper.
It is also my mission.
Regards for risk.
Well, it is my mission to talk to policymakers and bridge the gap in knowledge and understanding between the technology and where regulators are. Because without understanding, if regulators try to apply current regulatory frameworks, that's not going to work.
Well, at the moment, I mean, what happened yesterday?
You mean with the Trump token?
Anyway, look, we're getting off topic again. We should have,
right.
You and I should definitely have a Zoom, just the two of us, I think.
Let's do it.
Yeah. All right, so.
Can I ask a question?
Yeah.
So in terms of more like macroeconomics, in terms of equilibrium, so the more people are staking, the return will be lower, right? So in some sense, also like the looping has a kind of a macroeconomic effect that more people will use this strategy. We will end up in equilibrium that it's not going to be profitable to go to AVA and do more leverage because
that's a very good comment. There's a sort of equilibrium number of stake, equilibrium amount that can be staked.
Exactly. So if we do kind of this an exercise that we say we have only one leverage agent that can do the looping, he will find the equilibrium spot that he will not do another round because he knows that now. So I guess that by nature there is, beside gas cost, there is another element that put kind of a upper bound for the looping, if it makes sense, like the number of leveraging rounds.
Yeah. I mean, well, that's another good comment. Actually, I didn't look at the shape of this function here. I mean, my focus is on restaking, right? Not there has been some previous research on liquid staking, but this function is a nonlinear function. So how much do you have? How many rounds before you get about 80% of the reward would be quite interesting. Thank you. That's a nice comment. All right. So now let's have a look at how restaking works. And the reason I went over staking was so that you can understand this diagram, which is a little bit more complicated. And I haven't spelt out all the steps, but basically you start off with number 1 and number 2, but instead of going over there, you go down here and you put your steth with Renzo or another liquid restaking provider, okay? And then Renzo will act as a validator for eigenlayer. When you put it with Renzo, you choose the AVSs that you want to validate. Renzo gives you EZS, but there's lots of bad design in it. Steth is what we call a rebasing token. In other words, when you do your staking like this, the quantity of Steth you have increases, but the peg price is fine. But the way that Renzo have designed EZS is, first of all, they give you not 1-for-1, they give you equivalent value of EZS. And secondly, EZS is not a rebasing token in the same sense as Steth. It's more a compounding token. And we'll see the effects of that in a minute. So rather than clarify that now, because I will clarify it a bit more later, let's just go on with how this schematic works. So after you do that, you then deposit EZS with Aave. You'd have to use V3 protocol for borrowing S from Aave. And these are the parameters. And this is the EZS USDS or EZS ES and wrapped Steth. So you would then have to swap an extra. The EZS was not well received. Around the time I wrote this paper, I was in touch with a lot of people in the industry who were not supporting EZS. And although it was announced that Aave were going to do an EZS deposit EZS borrow S, it's not the case anymore. So that's one of the reasons why Renzo has not done very well. You'd have to go to 1inch or another DeFi aggregator to give your, for example, wrapped Steth, where, you know, wow, you can borrow an awful lot of wrapped Steth for EZS. So we need to have a look at the balance between those two tokens on all these numerous liquidity pools where you can swap them and see what's going to happen with the prices there. And the liquidation penalty is very small, whereas, you know, this is much more like a normal Aave market, where if I get liquidated, my penalty is 7.5%, which goes to the bots, the GitHub bots that do the liquidation. Okay. Anyway, so there are many steps. You go around this loop as many times as you like. And each time you put more S on Lido, you'll get more rewards. So you get your AB. And every time you put more Steth on Renzo, you will get more staking rewards. And this is reflected in the two sources of income here. Oh, keep going backwards. I'm sorry, I'm using my mouse instead of the down arrow. So, as I said, you receive the equivalent value of EZS, not 1 for 1. And just suppose, and this is not unheard of at all, I'm going to show you some recent prices. EZS frequently dips. So suppose that we've got a 0.99 price of Steth in S and a 0.66 price of EZS in S. So in that case, you'd receive 150 F, not 100 F. And then you've given them 100 Steth, which Renzo restakes on the eigenlayer, and then the rewards and the risks that you take depending on which AVS you select. Some calculations show that this is now the return, where alpha R is the APR from Renzo, and phi R is the net interest paid on Aave version 3. I'll look at this in more detail later when I introduce the strategy which I think EtherFi is using. But this is just to show you that I wrote the paper around here, May, and since May, only Kelp DAO, which I haven't had a chance to look at because I only actually went back to this paper on Monday. So there's a lot I need to revise on the paper, but Pufferfi was a big one. As you can see, that's gone right down. So has Renzo. I mean, the TVL for Renzo fell from 4.1 billion at the end of May to it's just over 1.15 billion today. The EZS in circulation fell from over 1 million to just 1/3 of a million today. There's more RSS, the Kelp DAO one. There's about nearly 500,000 in circulation of that, less of EZS. So it's really quite a liquid. When we look at the liquidity pools, let me show you them. Here they are. So let's have a look at EZS wrapped S here. That's on Camelot. And if I go back, say 6 months in West, you can see this upward trend and quite a few deviations. The upward trend is because the rewards are added to the price of EZS. So it's designed to trend upwards. It's not actually designed to be stable, which I think is a poor design. And then if I compare that also with I mean, this has got the biggest depth, most liquid pool, right? If I look at, say, this one, which I looked at before, this has not got much depth at all, but still there's some active trading. Let's look at Uniswap one. Again, let's go back. Well, here you can see it's in WETH already. Oh, it's not, but in WETH, there we are, look. So this was a couple of days ago, price went down to nearly just over 0.5 of ETH. And there was significant trading volume there. So that's a DPEG event that I just stumbled across today. Going further back, I wouldn't be surprised if there were others. Well, maybe not. Maybe it was just today. Somebody was playing around the day before inauguration, as lots of other people have been as well. It's a bit crazy in crypto markets at the moment. So DPEGs are really a risk.
Yeah.
And there was another one.
Can I ask a question?
Back in April. The Renzo governance token was airdropped. I mean, 2021 was really the year of the beginning of the year. It was all about airdrops. The end of the year, it was all about meme coins. But yeah, airdrops were not very well done. I won't go into, we've got time for more discussion. I won't go into this, but there's a link. You've got the slides, you've got the paper as well, about the unfair allocation. There's a Reddit post that does it pretty well, explaining why people were disgruntled. And so there was a rush to liquidate EZS. And because liquidators can take 100% collateral, it's much easier to produce a liquidation cascade. This was a CoinGecko Oracle price. As I said, on Balancer, the price went down to 0.81, and it probably went even further down on other less liquid dexes. So now let's have a look at diversifying some of this risk by, instead of just putting all your stats down here, you put a fraction on RVV2 to borrow S that way, and you put the rest on Renzo and get your EZS and borrow more S that way. And in the paper, the formulae are derived and input into this Excel spreadsheet, which, as I said, you can get from the Excel, from my website. You can change the parameters that I've used. These all seem fairly reasonable. Pi equals 1 is just liquid staking. Pi equals 0 is just liquid restaking. And in between, you've got the mixed strategies, which sort of grow with the amount you do on the restaking. And depending on the prices as well. So if we look at eigenlayer restakers, what does the landscape look like now? I needed to do this because I need to rewrite this paper to be a little bit more current. And I came across this, this chap or a lady who's been a wizard since May, taking gigs, called Walkbury. And it's got some really nice data that this person provides. On-chain analysts fighting scams and frauds for users' safety. Yeah. And here's a link to the website that he's running for June. You can see all sorts of statistics here. The average deposit size was much bigger for something called EigenPi that seems to have gone out of existence. So for people who used that. So over the last 14 days, about a third of the deposits for eigenlayer validation are from EtherFi, and a third are from Kelp DAO, about a sixth are from Renzo and a sixth for the rest. And in terms of the rewards, we've got, this is all time since 1st of January last year. So it's about a year of rewards, about a bit more than a third to the ES holders and a third to EZS, and then distributed amongst the others. So the landscape's definitely changing. So looking at EtherFi, it's doing really quite well. Total value locked today is 8.34 billion. It's the number 4 protocol in DeFi Llama. It only restakes native S. Okay, so it doesn't restake LSTs, but it does accept both F and STES, and it stakes and it restakes. So you can see the products here on EtherFi. You can stake and restake. You can explore that website later. Restaking native S is not very easy because you've got a lot of gas fees. In fact, there's a blog here where I picked this diagram from that calculates that 30% of the native staking, in other words, staking S as opposed to an LST, 30% of your rewards are going to be taken by gas fees. I don't know exactly how they calculated that, but that's the beauty of EtherFi, because it bundles all these requests. So what you've got to do is you've got to select one eigenlayer pod for each AVS that you validate, for each wallet as well. And then you've got to do transactions which are going to change your collateral, which you're getting as a validator with your S, to the eigenlayer pod. Oops. And you've got to divert the staking deposits and the rewards from Ethereum. Whereas with liquid staking, all you've got to do is put in your S, and then they do it for you to the AVS slashes. What Eigen.fi have done is to combine this with a nice bundled solution for that. So I definitely think I need to look at Eigenfi in more detail for the revision of this paper. So, I mean, given that the eigenlayer distribution by token is now 80% S, and it has really changed over time. From all these LSTs, it's now mainly S. I think the focus of the paper needs to look more at the risks on EtherFi. And also there are competitors emerging like Karak and Symbiotic that they allow you to restake using stable coins, liquidity provider tokens, wrap Bitcoin, and other ERC20 tokens too. So there we are.